There are ongoing shortages in the silver market, addressable shortages, but noticeable nonetheless. What's important, I think, is that this continuing shortage in the physical space means that the impunity and ease that large financial players and hedge funds had to use the physical market to spoof the term market, and the interplay between the amount of physical that is regarded as good delivery to secure trades on the LBME and the COMEX has changed.
This week's special with Miles Franklin Precious Metal Investments, 2021 Type 2 American Silver Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a returning guest who our viewers are always eager to see come back. This is Rick Rule, the CEO formerly of Sprott Asset Management, now of Rule Investment Media. Rick, thanks for joining us again this Tuesday, September 7th, 2021.
Always a pleasure, Donegan. I found this whole process to be fun and interesting.
It's certainly informative for me, and I believe I get to sit in here on the behalf of so many of our viewers. It's increasing in number rapidly since my son Elijah joined our troop. Our viewership has leapt. We were at 40,000 when I met with you in your office back in Carlsbad, and now we're at 60,000 and climbing. And our views are up about 92% month over month from previous months before he joined us. So we're grateful for that. And I get to sit here on behalf of all of them and ask you these questions. So I'm learning maybe as much as anyone. And one of the questions that's come up now, we've talked a lot about gold, silver, uranium, all kinds of different things, even water in the past. One thing we haven't talked about, Lasse Malton says, why is there no or very little interest, both from Rick and others in this sector, of the number one metal, tin, that will benefit the most from the green technology investments?
Well, I'm delighted to say that I was a seed capital investor and continue to be a large investor in an Australian listed company called Alphamin, which has succeeded against all odds in bringing the world's highest grade new tin mine into production. That mine is located in North Kivu in Congo, an area plagued by warlords, and the challenges associated with bringing that mine into production, not least of which has been dealing with armed warlords who wanted the rock, but also building a road 60 kilometers into a greenfield site, has been tremendous. The challenges that the team faced, they met successfully. So I've been myself quite a beneficiary of the increase in the tin price. It's very difficult when you look at opportunities in listed companies to find tin opportunities, precisely because tin was for so long selling below the global total cost of production. Tin existed in a bear market for 8 years, very much like the bear market that we're coming out of in uranium. And the consequence of that is that tin-focused companies were extremely rare because they couldn't raise capital. Mercifully for me, I found one such opportunity simply because the grade was too enticing not to participate. And mercifully again, I and my former clients are reaping the rewards.
So people want to find out more about that one. Again, the name of that company that you were talking about?
Alphamin, Australian listed, Congo focused. You need to take your tin with a bit of political and social risk. All
right. And another discussion here that you started back with us way back when you started talking about how people can get their toe wet in the natural resource investing space is to start with royalty companies, royalty and streaming companies. There's a question from Steve Fletcher. What are Rick's thoughts on the smaller sub $500 million royalty companies? Some, such as Elemental Royalties, seem to be growing a good business. What challenges or opportunities does Rick see in this area?
Both challenges and opportunities. The first are that they're competing in a space where the competition is fierce. Because the royalty and streaming business model is superior to most other financing models in mining, what it means is that the sector tends to attract the best entrepreneurs and the best managers, which is to say human resource talent is especially ferocious. Two, you are competing with several 800-pound gorillas in the space. Franco-Nevada, Wheaton Precious, Osisko, Royal Gold, smart guys with lots of money and very low cost of capital. Competing where you're a small guy against a big guy means that you have to be extremely nimble. This is a wonderful space for investors, although like every other narrative, which is to say every other subject, the application is what you need to pay attention to. Don't pay attention to the sector so much as stock selection. Your questioner might have noticed that amalgamation is beginning to take place among the smaller royalty and streaming companies, led by Amir Adnani, Garofalo, and the Gold Royalties team, which have taken over in very rapid succession Eli Royalties and now Golden Valley Abitibi. So I think you're starting to see consolidation in the space. I think that'll benefit the space, and I think it'll benefit investors in the space. But once again, stock selection is paramount.
People who have been concerned about the financial edifice and the direction things are heading are trying to protect themselves into natural resources and sometimes precious metals, that sort of thing. One of the concerns is about government overreach. That's something that concern is one you've shared several times with us. This is related to that. Quant 2011 asks, what do you think of Klaus Schwab's, quote, "you will own nothing" agenda, especially when he really fully means that literally?
Mr. Schwab needs to take into account that I own a gun. To the extent that he means to deprive me of my property and my liberty, he better own more than I. I have absolutely no intention of giving Mr. Schwab or his ilk the opportunity to deprive me of what I physically own and to try and make me happy by the loss of it. I think that's fairly clear.
Pacha Papa asks, would like to know Rick's exit/profit-taking strategies for stocks in different sectors. For example, precious metals, base metals, uranium, oil and gas.
I'm a valuation-oriented investor. I believe that money is made on the discrepancy between the price of something and the value of something. That means that I try and buy sectors and companies when they are selling for less than I think they're worth. And I try to sell them simply for when they're selling for more than they're worth. The question, as asked, would take 2 hours to answer. So let's focus on one little segment of it in terms of using it as a teaching moment. With regards to precious metals, I believe that the current bull market in precious metals is a consequence really of four big factors. The first of which is quantitative easing, i.e. counterfeiting. I believe that debasement of the currency makes investors nervous about savings products that are denominated in that currency, and quantitative easing, which is to say counterfeiting, is certainly one of those. The second would be debt and deficits. Debt and deficits are bad for the currency for two reasons. Government borrowing crowds out private borrowing, while it weakens the balance sheet of the creditor in government bonds. So debt and deficits are bad for dollar-denominated savings and conversely good for gold. The third, of course, is negative real interest rates, which is the ultimate silliness. Can you imagine paying somebody to borrow from you, taking on the credit risk and forestalling consumption in their favor, and paying them for the privilege of doing that? I certainly can't. The value proposition offered up by the U.S. 10-year Treasury is that they pay you 120 basis points in a currency that's depreciating by 450 basis points. Return-free risk, as Jim Grant would call it. Finally, of course, the market share of precious metals and precious metals-related securities is less than 0.5% in the United States of America, down from a 30-year mean of 1.5%. If quantitative easing, debt and deficits, and negative real interest rates were, which I believe they will, able to cause gold not to win the war against the dollar, but merely to revert to the 30-year mean, demand for precious metals and precious metals-related assets would triple. So circumstances where the probabilities are much higher than not that precious metals prices will go higher makes me a buyer. When will I become a seller? Simply when the set of circumstances that should propel gold higher goes away. When governments end quantitative easing, when budgets are balanced, or at least when the growth of government debt is less than the rate of growth in the economy to make it affordable. In particular, when interest rates return positive. And when the market share of precious metals and precious metals related assets is substantially above mean. I'm not saying this in an attempt necessarily to get people to buy precious metals and precious metal stocks, but rather in answering the question, what is my exit strategy? When the set of circumstances that causes an investment thesis changes, then my investment strategy has to change. When precious metals become fairly priced or overpriced, when their market share goes from below mean to above mean, then you need to re-examine your premise, but not until then.
A follow-on question that I'll add to that, it actually comes based on this viewer's question from Andrew Rosenberg. Since you mentioned precious metals as a whole, there's a distinction. He says, Lobo Tigre makes the point that going forward, silver may correlate stronger with copper, industrial, than with gold, monetary. Does Rick Rule foresee the same possible future scenario?
I don't see myself as being a macro strategist particularly. So the answer is I don't know. What I've learned the hard way through 45 years of forecasting is that forecasts often tell you more about the forecaster than they do about the future. So I try to look at things historically. And in my experience, the second half of a precious metals bull market is silver dominant, as the narrative goes away from fear, which favors gold, to greed, which favors momentum and silver. In my experience, the prior two precious metals bull markets that I have lived through have seen silver take predominance over gold in the second half of a bull market. Not being able, sadly, to predict the future, I have to say that the probabilities from my point of view are that past is prologue.
People who are looking at the commodities or natural resources area for investment or speculation are wondering where to position themselves and when. You're talking about this value lens through which you look at all of this. DJ asked the question, what sector will have the most 10 baggers from here during this commodities cycle?
Irrespective of commodity, I think exploration will. But it carries with it the greatest risk. Whether or not somebody is able to afford, either financially or psychologically, both the absolute risk and the volatility inherent in exploration speculation is a question that each individual investor needs to ask himself or herself. I've done this for 45 years. I am very familiar with volatility. I am very familiar with risk. I'm very familiar with loss. I understand that in speculation, enduring losses is the key to outsized successes. Many speculators lack my nerve. They lack my means, which is to say they can't afford loss. And even if they can afford the loss financially, they can't afford the loss psychologically. So a better question that an individual investor or speculator might ask himself or herself is, given the probabilities of bull markets in natural resources and precious metals, what conjunction of risk to reward is most appropriate to my financial and psychological circumstance?
One of the questions that's related to that is the timing of things. People are looking with some concern at markets, at equity markets at all-time highs, almost on a daily basis, bond markets, real estate markets, the bubble of everything. Eddie Borma is one of several who asked this basic question: should I invest in miners right now, or is it better to wait for a future market crash because the miners will go down also?
That depends very much on the individual and the information, the individual's time frames. I, as an example, right now am investing in a couple of community bank stocks, despite the fact that I think that interest rates are going to go up, that I think the lending environment around real estate is going to be more challenged. I believe in these management teams. I believe in their business plan. It is not unlikely in a stock market crash that the prices of these community banks will fall by 50% in the near term. In the longer term, it is almost certain that these businesses will become more valuable over 10 years and that their prices will ultimately reflect that. Having been an investor now for 45 years, I've been involved in 4.5 10-year timeframes, and I am very willing to do that. Your questioner may not be willing to do that. He or she needs to come to grips both with their means, which is to say how much risk they can afford financially and psychologically, and also with their timeframes. I'm on record as saying that in my life, every 10 or so years, it doesn't need to be 10, we see some exogenous shock hit the market that causes the broader equities market to come off by 30% or 50% or some number like that. I'm completely conversant with the fact that that happens, and I anticipate it's going to happen. And if it happens, the price of mining shares, like other shares, will fall. What you notice, having been through as many markets as I, is that higher quality assets recover more quickly and recover to higher highs. Remember that money is made on the conjunction of price and value. And the right time to buy something that's selling for less than it's worth is when you can.
Yeah, it's no fun trying to sell something when you're not the first person who had that idea and there's a rush for the exits, that's for sure. Sarge 27271 says, what does Rick think of Russia's recent deals? He may be thinking about oil deals, and China's Yuan about to be launched.
I think the Yuan is a very clever piece of policy by the Chinese. The idea that they have a currency that they can withdraw if your social skills or social scores aren't high enough is particularly pernicious. The conjunction of fascism and technology is always something that's terrified me. I'm impressed with the formalization of Chinese control over all aspects of Chinese society. When I say I'm impressed, I'm horrified. But I think it's interesting. Now, the truth is, an yuan, where the Chinese government could actually cancel the currency, would have exactly no value outside China. I mean, exactly no value outside China. Would you want to accept an yuan if you knew that the Chinese could monitor liberty and finance and decide that you weren't a friend of the Chinese people, and as a consequence of that, cancel some of your savings? Of course not. Nor would anybody, to the extent that what the Chinese would like is a bigger say in the global economy and larger participation in the global economy, access to more foreign direct investment and the growth of the Chinese economy. Those goals are inconsistent, with the type of control that they are attempting to have with the yuan. As for the Russians, I think they're being entirely pragmatic. The recently completed Nord gas pipeline, as an example, gives Russians much better access into the European gas market at the same time that the Europeans have more need for Russian gas. It probably forestalls a similar move by the South Stream pipeline, which is to say it gives the Europeans the fossil fuel energy security they need to overcome their disastrous wind and solar investments. I'm being tongue-in-cheek here, but I think that the Russians have been, by and large, extremely pragmatic. I think they've done a better job running their country than I would have believed possible 10 years ago. The one example would be, at least by U.S. and Canadian standards, extremely low tax rates. Wonderful depreciation schedules. The truth is that if you are a businessman that doesn't get yourself involved in politics too much, communist Russia is much freer than America. I know that that's going to get me a lot of hate mail from your readers, but that's okay. If you look at the arithmetic, would you prefer an 18% marginal tax rate, or would you prefer a 39% tax rate? Would you prefer, if you were building a tilt-up concrete building, to amortize that building for tax purposes on a straight line basis over 33 years, the way we do in the U.S., or would you prefer to expense it in the first year, the way the Russians do it? I would suggest that Russia, for all its faults, is, from an economic point of view, much more pragmatic than the United States.
What about their foreign agreements they just made with, like, the Kingdom of Saudi Arabia or with Nigeria for military cooperation or buying oil outside of the dollar system?
The Russians are emulating U.S. foreign policy in the 1950s and 1960s, which is to say they're being entirely self-serving. The Russians look at the oligopoly that the U.S. has with regards to foreign arms sales. The largest arms merchant in the world's premier merchant of death, is, of course, the United States. And the Russians would like the ability to amortize their defense budget, which is much smaller than the United States', over a much larger audience. And given the vacillations in U.S. foreign policy, the Russians have begun to cast themselves as a reliable long-term partner. where that partnership isn't subject to the whims of internal politics, whether you agree with Russia or don't. And many aspects of Russia I don't agree with. I think it's an intelligent, self-serving process. From the Saudis' point of view, the guarantee of U.S. protection for very many reasons over very many conflicts around the world is being called into question. Russia's steadfast support of the Syrian regime, however odious that regime might be, means that leaders in that part of the world who are looking for a reliable partner need to think more about Russia and more about China and less about the U.S. This isn't Russia's fault or China's fault. This is the U.S.'s fault.
I forgot to ask you this question. We were talking about silver earlier. When we had you on over a month ago, maybe 2 months ago, there was this phenomenon, the Sprott having purchased up all this rings and rings of physical silver available in North America, that sort of thing. Since then, there seems to have been the sense of a loosening up of availability of silver globally. How are you seeing that? Or are you still connected with that process as far as Sprott's being able to acquire physical silver in the quantities necessary to support investment demand without having to go to extraordinary efforts to do so?
It's ironic that even as the the supply of retail inventory increases, that is to say, the extraordinary shortages that we saw in retail silver product are beginning to be addressed. In particular by the reopening of COVID-closed refineries in Switzerland and other places. The amount of silver that was taken out of the market by the so-called silver squeeze has meant that although Sprott is still able to buy institutional quantities, it is not easy. There has been a fundamental change in the availability of silver. That isn't to say if $15 million rolls into the Sprott Physical Silver Trust, we will be able to buy the silver, but we won't be able to buy it in 7 or 8 seconds of responsible trading, the way that we were 2 years ago or 3 years ago. There are ongoing shortages in the silver market, addressable shortages, but noticeable nonetheless. What's important, I think, is that this continuing shortage in the physical space means that the impunity and ease that large financial players and hedge funds had to use the physical market to spoof the term market and the interplay between the amount of physical that is regarded as good delivery to secure trades on the LBME and the COMEX has changed. If I were the risk manager for a very large bank that was trading in silver and speculating on the arbitrage between the near-term physical market and the long-term paper market, I would be much less cavalier today than I would have been 2 years ago.
Also, you've been getting some news and some press and a lot of interest, probably about a third of the questions that have been submitted ahead of your arrival here regarding Sprott's purchasing of physical uranium and starting a uranium fund. Can you give us an update on what's the progress there and what you see happening?
First of all, your readers need to understand that I'm no longer an officer, director, or employee of Sprott. I'm still in the board of directors, and I'm still, as far as I know, the largest shareholder. And I want to begin by thanking my former colleagues at Sprott who have worked 3 years to make this transaction, which I've championed the whole time, a reality. I think this is wonderful for the uranium market. I think it's wonderful for our customers who either have or will buy the trust. I think it's wonderful for the shareholders. I think it's wonderful in all regards. For those listeners who don't understand what this refers to, I have been, as you know, Donegan, and many of your listeners know, a bull on uranium for 3 years, believing that the overabundance of supply in the spot market would go away, and then that the price of uranium would return to the cost of production, total cost of production in terms of cost of capital, meaning that the spot price of uranium would rise, from my point of view, from $16 to some number around 60. Sprott was able to take management control of the largest physical uranium investment vehicle in the world, the old Uranium Participation Corp. And we changed this form of organization from corporation to trust to make it, among other things, more tax efficient, in particular for U.S. shareholders to buy. The market's response to that has been spectacular. Sidebar, In other types of physical trusts, our gold trusts, our silver trusts, our platinum and palladium trusts, we manage in excess of $12 billion on behalf of 280,000 investors worldwide. We have believed for 3 years that an understanding of the uranium narrative would translate well to people who understood the precious metals narrative. And we believed that by telling the uranium story to our existing 280,000 person investor base, that we could increase demand for the trust, and as a consequence of that, increase demand for physical uranium. We just didn't know how right we were. Our strategy has always been to list the trust on the New York Stock Exchange, where we generate over 90% of our volumes. But just listing it on the Toronto Stock Exchange and putting in place an at-the-market facility where when the trust sells at a premium, we can issue new units and use that money to buy physical uranium. I think it's fair to say that Sprott and the trust almost by itself has increased the spot price of uranium from $32 to $38, causing one commentator today to refer to the spot price as the Sprott price. This has been an amazing response. Now, I believe that the increase in the price of physical uranium will begin to moderate. I believe that holders of inventory, seeing the graph that everybody else has seen over the last 2 weeks, have begun to withhold supply from the market, figuring, why should I settle for 37 or 38 when if I wait for 3 weeks, I can get 41 or 42? The classic old fear of missing out. There will come a point in time, I think, when inventories that are accessible to the spot market, which I still believe are fairly substantial, meet with demand. And at that point in time, I think that you'll see Sprott able to buy larger quantities of physical uranium on the spot market. I deliberately, because I'm a shareholder both of Sprott and Sprott Physical Uranium, have not involved myself in the intricacies of the management of the Sprott Physical Uranium Trust, which I couldn't do, but I might be tempted to do as a director. But I notice that Sprott has been very transparent with regards to posting net asset value, the price of the trust, and whether or not the trust has purchased any physical uranium on a daily basis. And I note that the premium on Sprott Physical Uranium continues to be very strong in the market, when the stated policy of Sprott is, to the extent that uranium is available, to issue new units anytime that the trust is at a premium and use the proceeds to buy physical uranium. It would appear to me, although I have no inside knowledge, that at present, Sprott isn't able to buy enough physical uranium in the spot market to monetize away the premium that you're seeing between the price of Sprott Physical Uranium Trust and the net asset value of the trust, which is to say the spot market continues now to be extremely tight.
You've spoken and you've even organized conferences in the past about ethics and morality in investing and so on. What do you say to address those who express concern about the ethics on the big picture of the nuclear power industry in general, because of the concerns around storage, around accidents, saying that we're messing with something that's too powerful for our knowledge? How do you respond?
I would take that criticism seriously if the person who posed it didn't believe in government. I suspect that the biggest risk to all of our physical health is war, and without the state, there is no war. Getting down to the question, however, getting maybe a little less moral, I would say that a review of the technical facts around nuclear power suggests it's a risk very well worth taking. Background radiation, as an example. Fly ash heaps from burning coal in eastern Ohio, western Pennsylvania, generate more background radiation than every nuclear power plant in the United States combined. That would be one example. Two, what are the health risks for 1.2 billion people in the world that don't have electricity, for their not having electricity? Do those people have rights? Just out of curiosity? Is it ethical to allow 1.2 billion people on Earth not to have electricity or to have to pay too much electricity? I don't think so. I think that you have to balance various risks. Certainly, when engineering goes wrong in nuclear power, the potential risks are very high. But when you look at the actual risks to life and limb around, in particular, things like Chernobyl, but also 3 Mile Island, and you compare them to things like the natural gas pipeline rupture on the San Francisco Bay Peninsula that killed 42 people 9 years ago, what you find is that a riskless future is inconsistent with the future that many of us want to live in. I'm not unconcerned, although some of my colleagues are unconcerned about carbon-caused global warming. I don't believe that man-made causes are responsible for all the increase in temperature that we've seen. I think that there are other factors. But I do think that as a species, we need to put less crap in the air and in the water. And I think that the risks of not considering airborne particulate pollution in our energy mix has its own risks. I think, too, when we consider carbon in the West, our nervousness is always that poor people in the third world are increasing their consumption of carbon. But when you look at the global carbon budget, you have to take into account historic emissions, all of which are ours and all of which are still in the atmosphere. And you have to consider emissions per capita. We're getting all high and mighty and self-righteous about criticizing the rapid increase in Chinese pollution until we realize that Chinese pollution is a function of two things. One, our outsourcing our manufacturing capabilities to them, which is, in other words, making them emit rather than our emitting, and looking at Chinese emissions per capita relative to our own emissions per capita. When you look at nuclear through the total lens of safety, through the lens of the amount of electricity that the world is going to need 15 years from now to raise the living standards of the people on Earth who either don't have electricity or can't afford electricity, then you begin to see the nuclear power industry in its true lens.
Another topic that comes up talking about looking at the future is the future role of rare earth metals and minerals in our electric economy, that sort of thing. 49Fine says, what do you believe is a good conduit for exposure to rare earth metals? Are these critical for the future teching of society? That seems to be an opportunity.
Two different questions. The answer to the second one is absolutely. Technology is responsible for the ascent of man. For the politically correct among you, the advance of humankind, not man. And mercifully for all of us, technology is galloping. And this whole electric future requires all kinds of little elements that most of us can't pronounce or even spell. So I think the future for rare earths is very bright. Fortunately for humankind, unfortunately for the people who produce it, rare earths aren't particularly rare. They're substantially more abundant in the Earth's crust than, as an example, gold would be. We haven't spent much time looking for rare earths because the Chinese produce them in Western China so cheaply that there hasn't been a need on an economic basis for going and finding these things. There's a very large rare earths mine in eastern California called Mountain Pass that's gone bankrupt 3 times in the last 30 years, not because they don't have rare earths, but because they can't produce it in a way that competes with the Chinese. As demand for rare earths increases, and particularly as the Chinese become less tolerant of the environmental degradation that has been caused by their own rare earths industry, I think you'll see rare earth prices rise. There are not, unfortunately, very many ways to play the game. The companies outside of China that are important in rare earths are major diversified mining companies who, while they produce a reasonable amount of rare earths as a byproduct of other minerals, don't have their future determined by rare earths, which is to say that rare earths is dominated by big mining companies, but the big mining company share prices are absolutely unresponsive to rare earths. This is a theme that will attract investor attention over the next 10 years because the exploration cycle for rare earths, at some point in time in the next 2 or 3 years, is going to get underway in earnest. Mostly, you will see amalgamations of butchers and bakers and candlestick makers. that form a company around rare earths and purport to be looking for things that they can't pronounce, so that most of them will be dismal failures. But also we'll have some spectacular discoveries. Those discoveries will take place in, old Archean and Proterozoic terrain around the world, probably in countries that scare us. Probably places like Kazakhstan, probably in Siberia, probably in Congo. But a lot of money is going to be made by the wise.
There are so many more questions. We're not going to have time to ask them all. We're going to have you back on. I know we're looking for some chances to have you on as a panel member and also on the other side of the table, so to speak, of interviewing with me some CEOs from some other companies that our audience have not met yet. But would you like at this time to renew your offer to rank our viewers' portfolios for natural resource stocks?
Always. Your long-term listeners know that I encourage conversation with them by offering on a no obligations basis to rank their natural resource portfolios. Please, no cryptocurrencies. Please, no pot stocks. Please, no technology stocks. Natural resource stocks only. Go to sprottusa.com/rankings. Enter your natural resource portfolio. If I know the company, I will rank it 1 to 10, and I will comment on companies where I think my rankings might have value. If you include the word charts in questions and comments, I will include in my response both the Barron's Gold Mining Index chart, the longest running and most comprehensive gold equities index chart on the planet, and a 100-year commodity chart, which will show your readers just how cheap the stuff of humankind, raw commodities, are relative to other investment classes going back 100 years. Once again, sprottusa.com/rankings.
Well, Rick, as always, on behalf of all of our viewers, I'm grateful for you joining us here again here on Liberty and Finance, and just look forward to our next visit with great anticipation, and just thanks for being here.
A pleasure, Dunnigan, and I hope that all of the listeners who listen to this listen to the company interviews. Whether or not you buy the stocks, watching the questions that are proffered to companies in real time is a wonderful way to learn the craft of investing and speculating in natural resources. I really, really enjoy doing these interviews with you, and I congratulate you for bringing that service to your listeners.
I guess it's a good example of teach a man to fish and he'll never go hungry again. So thank you very much for that role modeling as well.
Pleasure.
This week's special with Miles Franklin Precious Metal Investments. 2021 Type 2 American Silver Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.